Hello, I'm Emma Wall and I'm joined today by Roger Clark to talk about value investing and growth investing. Hi Roger.
Hi there.
So what is value investing and what is growth investing?
Well, I guess the first point is there's no universal definition of value versus growth, so depending on who you talk to, you might get a slightly different answer, a slightly different metric that a fund manager, for example, looks at. I guess generally, growth investing will be associated with higher quality businesses. Often they're a bit more expensive and you have to pay a higher multiple of profits to invest in those shares. They might be higher quality, they might be more defensive type businesses, so maybe a Nestle or a Unilever, something like that. Value, however, slightly different, opposite end of the spectrum, so often viewed as slightly lower quality, but they might have a higher dividend payout, dividend yield perhaps. So a few slightly defining factors there.
And these two styles of investing, like any style of investing, can fall in and out of favour, can't they? And growth has done incredibly well recently, while value has struggled.
Exactly. I mean, it's been particularly marked recently, and a number of commentators are talking about the prevalence of growth over value of late. But it's not always been the case. So, for example, value had a fantastic run from the tech bubble, so 99, right the way up to 2007. And then that's lastly been replaced by growth, which has been on a phenomenal run since.
And investor sentiment and investor inflows often follow a period of positive performance, which can be dangerous because, of course, past performance is no guarantee of future returns. However, it does beg the question about when the right time to invest in value is. When do you give up on growth, or should you really be investing in both?
Sure. I mean, our approach is very much not to try and time these things, so we don't think we have an edge on guessing when value will stage some sort of resurgence. I think in reality it's important to have a diversified portfolio. So firstly, to understand the biases of the funds you're investing in or the shares you're investing in, and then to have a bit of both so that the whole portfolio is not pointing in one sole direction. And
where at the moment on a regional or asset level are you seeing good value?
So first point is we don't think any market is screamingly cheap at the moment. We tend to look at things based on the long-term average. So we look at the market price now as a proportion of earnings over the long term. We think some areas are looking relatively cheap. So Japan would be the cheapest of the developed markets that we see. Asia looks reasonably attractive as an emerging market. Right the way up to the other end of the spectrum, where something like the US we think looks pretty expensive. So quite a range. Nothing we think is very, very cheap, but that certainly doesn't mean that you shouldn't invest, and indeed we think there's still plenty good opportunities for the long term.
Roger, thank you very much.
Thank you, Emma.